Economic data in the United States still caught investors off guard. Beijing is laying out concrete steps to boost its economy on a larger scale through long-term bonds. Australia recorded an increase in unemployment above forecast, and Japan reported weaker than expected GDP data for the first quarter. Nevertheless, the currencies of the Asia-Pacific region strengthened against the US dollar today. For a start, the dollar-yen pair fell to 153.70, its lowest level in almost 2 weeks. This is despite Japan's economy contracting 2% year-on-year in the first quarter of 2024. GDP growth forecast of a 1.5% growth defied expectations as a private consumption in the country declined for the fourth quarter in a row. The latest data complicates the task for the Bank of Japan, which needs to balance support for the economy with the efforts to protect the weak currency. However, an even greater surprise for everyone was the decline in inflation in the United States. The annual CPI dropped from 3.5% to 3.4% and naturally caused further weakening of the dollar. Then the pressure on the US currency worsened even more after retail sales data were published. The growth rate slowed down in April so much that it fell to zero. The disappointment was especially painful as the forecast had only expected a moderate decline from 0.6% in March to 0.4% on months. Thus, the evidence that the US economy has been losing momentum has been confirmed once again. In theory, the situation could be improved by data on industrial production in the US published today, if, of course, they show growth rate at least at the level of the estimated 0.2%. However, several policymakers of the Fed Reserve are also making their remarks today. After yesterday's inflation data, they will be asked relevant questions. Indeed, they will hardly await this issue. Most likely, the rhetoric of policymakers is still shifting towards monetary easing. This dovish shift may well lead to an even further weakening of the US dollar, and yesterday the US currency logged its sharpest one-day percentage drop in a year, immediately losing 0.75%. Other currencies hit multi-month highs against the US dollar before stabilizing. Analysts say further dollar selling will likely depend on how the US and other policymakers react to the incoming statistics. In the meantime, on early Thursday, the US dollar index tumbled to a 5-week low of 104.07. Then it again moved into the green corridor between 104 and 104.40, waiting for the next news. The US stock market responded to the slowdown in inflation with a rapid rally in all three benchmark indexes. The S&P 500 jumped by 1.2% yesterday, reaching a high of 5,308 points. And today it seems to be preparing to storm new highs within the intraday corridor between 5,263 and 5,312 points. However, there is one more important factor to keep in mind. The 10-year US Treasury yield sank after the US CPI report to 4.34%, its lowest level since April 5. In this context, the scale of the dollar's weakening looks so serious that it's quite possible to talk about the oversold market. Other rivals from the basket of currencies managed to test multi-month highs against the greenback before stabilizing. For example, the AUD-USD pair increased by 1%. Further sell-offs of the US dollar are directly dependent on the reaction of financial policymakers to current economic data. For example, if the Bank of Japan rushes to raise interest rates before the Fed Reserve begins rate cuts, Data on the retail sales and the consumer price index in the United States no longer provide much needed comfort for risk indicators. The possible timeline for the first rate cut by the Federal Reserve has again moved to September. According to the FedWatch tool, investors now estimate the likelihood of a Fed rate cut at 75% in September and 85% in November. The euro-dollar pair is also gaining ground on the back of a possible approachment of a monetary policy between the Eurozone and the United States. During the initial speculative move, its euro almost reached the level of 1.09. As a result, the single currency has grown by about 1% since the beginning of the week, which may indicate that the euro is overbought. And today the euro-dollar pair is trading flat, trying to continue its winning streak for the fourth session in a row. In this situation, a technical sign that the euro is overbought may trigger a local pullback within the intraday range of 1.0870 to 1.0900. In theory, this should inspire traders to add more long positions, as the euro will be able to regroup trading forces. As for a further bullish move, it will be considered by traders after the euro-dollar pair settles above 1.2900. In this case, the price may move even higher to the psychological level of 1.10. As for oil prices, they initially responded by rising not only to inflation in the United States and the weakening of the dollar. A rally in oil prices was also facilitated by a further decline in the U.S. crude oil inventories. According to the U.S. Energy Department, oil stocks contracted by 2.5 million barrels last week. However, the global situation has remained unchanged, and the Brent price is still moving in the range of $82 to $84 per barrel. Yesterday's data led to the price movement towards the upper border, which has not been reached yet. And today the market is likely to hit exactly this mark. Perhaps an attempt will even be made by break through it. But for oil to escape from the range-bound market, something more significant than overseas statistics is needed. After all, at the end of the trading day, the Brent price returned to the opening levels, so we can expect a reversal in the oil market in the future in the direction of $82 per barrel. You have watched the market review by InstaForex analyst for Thursday, May 16. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. See you online tomorrow.